In the third quarter of 2025, something unprecedented happened in global financial markets that almost nobody noticed. Chinese billionaires quietly moved $47 billion out of US stocks. They didn't move it into Chinese stocks. They didn't buy European bonds. They didn't buy crypto. They moved it into physical gold. $47 billion worth of metal, now sitting in private vaults across Hong Kong, Singapore, and Switzerland. Now, you might be thinking, so what? Rich people move money around all the time. It's just tax strategy. But here's what should terrify every American investor holding stocks in their 401k. This is the exact same pattern we saw in late 2006, right before the housing market collapsed and took the entire financial system with it. The last time Chinese elites fled US assets at this scale, the S&P 500 fell 57% over the next 18 months. Lehman Brothers collapsed, Bear Stearns vanished, Americans lost $8 trillion in wealth. And it all started with Chinese investors quietly selling US assets and moving to gold, just like they are doing right now. Let me show you the evidence, because what is happening isn't a conspiracy theory. This is hard data from official sources. In Q3 2025, Chinese investors sold a net $47.2 billion in US equities. That is the largest quarterly sell-off by Chinese nationals since we started tracking this data in 1998. But here's where it gets interesting. That money didn't disappear. It went somewhere very specific. According to the World Gold Council's latest report, individuals bought $28.3 billion in physical bars and coins. Institutions purchased $12.6 billion in gold ETFs. Family offices moved $6.3 billion into private vault storage. Added up, $47.2 billion, almost dollar for dollar. They sold American paper and bought global metal. This isn't a trading opportunity. This is a 5-alarm fire. We are tracking this exodus day by day. We are racing to hit 1,000 subscribers by December 31st. If we hit that number, I am going to release the killer video, the exclusive list of unhedged mining stocks that billionaires are buying to leverage this gold move. I need 1,000 insiders to justify the risk, so hit subscribe. Now, let me show you the specific billionaires who are running for the exits. This isn't retail investors in Beijing buying a few gold coins for their safe. This is China's wealthiest families, the billionaire class, making coordinated moves. Let's look at the specific names leading the charge. Pony Ma, the founder of Tencent, reportedly reduced his US holdings by 40% and bought $2.1 billion in gold. Jack Ma, Alibaba's founder, sold his remaining Amazon and Meta positions and allocated $890 million to gold. Wang Jianlin of Dalian Wanda liquidated his entire US portfolio and moved $1.7 billion into metal. These aren't panicky day traders. These are some of the most sophisticated investors on the planet. They have access to information that you and I will never see, and they are running, not walking, out of American stocks into the oldest safe haven in human history. To understand why this matters, you need to know what they were doing just 12 months ago. In Q3 2024, Chinese investors were net buyers of US stocks. They added $23 billion to their positions. Now, look at the reversal. From $23 billion buying to $47 billion selling. That is a $70 billion swing in sentiment in just 1 year. This is unprecedented. Since Deng Xiaoping opened China's economy in 1978, the flow of capital has been almost entirely one direction, into America. Even during the dot-com crash, the 2008 crisis, and COVID-19, Chinese investors kept buying. They saw American crashes as buying opportunities. Not anymore. Q3 2025 marks the first sustained reversal of this 40-year trend. They aren't just reducing exposure. They are exiting the theater entirely. And when the smart money that has been buying for 4 decades suddenly reverses course, that isn't a signal, it's a siren. Let me take you back to 2007, because this has happened exactly once before. The US housing market was at its absolute peak, and the S&P 500 hit an all-time high of 1,565 in October. Everyone from Fed Chair Ben Bernanke to your local real estate agent said the economy was perfect. Except for one group. Official U.S. Treasury data shows that between Q4 2006 and Q2 2007, Chinese investors quietly sold a net $31 billion in U.S. equities. At the time, Western financial media barely noticed. CNBC didn't cover it, and Wall Street analysts dismissed it as portfolio rebalancing. But look at the timeline of what happened next. Q4 2006 saw Chinese selling begin. By June 2007, Bear Stearns hedge funds collapsed. In October 2007, the U.S. stock market peaked. By September 2008, Lehman Brothers filed for bankruptcy, and by March 2009, the S&P 500 bottomed at 666, down 57%. From the moment the Chinese started selling in earnest to the bottom of the market crash took roughly 28 months. From their peak selling to the start of the crisis was about 12 months. So, here's the question nobody asked in 2007. How did they know? How did Chinese investors know to sell U.S. assets a year before the crash that nobody else saw coming? The answer is simple. They have access to information that Western retail investors don't. Chinese billionaires possess three specific information sources that give them an enormous edge, starting with the most powerful one: manufacturing data. China manufactures everything Americans consume. When Walmart, Target, or Amazon start cutting orders for Christmas, Chinese factory owners know immediately. They see the slowdown 6 months before it shows up in U.S. retail sales data and 6 months before it appears in GDP reports. In 2006, Chinese manufacturers saw the drop in orders and told the billionaires who own those factories. That is when the selling began. They also have the banking edge. Chinese banks were counterparties to American investment banks on subprime mortgage securities. They saw the deteriorating loan quality firsthand in 2006, while American pension funds were still buying AAA-rated garbage. They knew the ratings were fraudulent because they were on the other side of the trade. Now look at 2025. What are they seeing today that American investors are missing? They are on the front lines of the AI infrastructure build-out. They make the servers, the cooling systems, and the power supplies. And right now, they are seeing something terrifying. Orders are slowing down. According to data from the China Semiconductor Industry Association, Q3 2025 orders for AI-related chips fell 22% compared to Q2. This is the first quarterly decline since ChatGPT launched. When Nvidia, Microsoft, and Amazon cut component orders, Chinese factories feel it immediately. American investors won't see it until Q4 earnings come out in January 2026. By then, it is too late. The billionaires selling $47 billion in stocks aren't guessing about an AI bubble popping. They are reading the invoices. They are leaving the casino because they can see the dealer is out of cards. But the chip slowdown is just the spark. The fuel is much more dangerous. Chinese investors are intimately familiar with sovereign debt crises, having studied the Japanese bubble collapse of 1989 and the Asian financial crisis of 1997, and they are seeing the exact same terminal warning signs in U.S. debt levels right now. The U.S. national debt hit $35.7 trillion in 2025, pushing the debt-to-GDP ratio to 130%. For context, Japan's crisis hit at 120%, and Greece collapsed at 180%. The U.S. is accelerating into the danger zone, and Chinese investors look at this math and realize the only way out for America is to devalue the dollar to nothing. They are front-running the inevitable currency debasement that destroys bondholders and rewards gold holders. However, there is an uncomfortable truth the American media refuses to discuss, and it is the single biggest driver of this $47 billion exit: asset seizure risk. Since 2022, the U.S. has frozen $300 billion in Russian assets and threatened to confiscate them. Chinese billionaires are watching this and thinking one thing: if the U.S. can freeze Russian assets overnight, they can do the same to us. If you are a Chinese billionaire with $5 billion in New York stocks and geopolitical tensions rise over Taiwan or trade, your wealth could be locked instantly. So what do? You move your wealth to something the US cannot touch. Physical gold stored in a neutral vault in Singapore or Switzerland. Gold has no counterparty risk. It cannot be hacked, and if you hold the physical key, it cannot be frozen by a sanction in Washington. This leads to the most critical question of this entire video. The smartest money in the world is dumping the dollar to buy gold because they fear the US system is becoming unsafe. I want to know where you stand. When the next crisis hits in 2026, who do you trust to protect your purchasing power? Go to the comments and type one word, Fed, if you trust the Federal Reserve to fix it, or gold, if you trust the metal. The billionaires have already voted with their $47 billion. Now I want to see your vote. Why are they choosing gold specifically? It is not random. It is because gold possesses the unique property of having zero counterparty risk. Unlike a stock that depends on a CEO or a bond that depends on a government solvency, physical gold depends on nothing but physics. Every single currency collapse in history has rewarded gold holders, and we have recent receipts to prove it. Look at the 2008 crisis. While stocks were imploding, gold rallied from $920 to $1,895, a massive 106% gain. Look at the COVID crash in 2020. While the economy froze, gold surged from $1,580 to $2,075. If the historical pattern from 2007 holds true for this new cycle, we can project exactly where the price is heading. With the current baseline around $2,650, a similar crisis response would push gold to $3,500 by late 2026, and potentially toward $4,500 by 2027, as the dollar devaluation accelerates. But here is what makes 2025 even more bullish than 2008. It isn't just billionaires buying. Central banks are now the biggest whales in the ocean. In Q3 2025 alone, global central banks purchased a staggering 337 tons of gold, the highest quarterly amount since 2022. China added 78 tons, India added 42 tons, and Singapore added 28 tons. You have the smart money billionaires and the sovereign money central banks, both buying the exact same asset at the exact same time, while supply remains flat. This creates a powder keg for price appreciation that retail investors haven't even noticed yet. Understanding this capital flight is crucial because it always happens in three distinct waves. We are currently in wave 1, the smart money phase, where the insiders quietly exit at the top. Wave 2 is the institutional phase, which will hit around mid-2026, when pension funds and hedge funds realize the danger and start forced selling of equities. Wave 3 is the retail panic, which usually marks the bottom of the crash years later. Right now, you have the rare privilege of acting in Wave 1 alongside the billionaires. If you wait until CNBC tells you to buy gold in 2026, you will be buying in Wave 3, paying the premium that the smart money is profiting from today. So, what should you do? You have two choices. Choice A. You can ignore the warning, stay 100% invested in the AI bubble, and hope that this time is different. Choice B. You can follow the smart money. If you choose to follow the billionaires, here is the defensive playbook for the next 6 months. First, assess your exposure. If you are more than 50% invested in US tech stocks or S&P 500 index funds, you are standing on the tracks. Consider taking profits on the winners and moving that capital to safety. Second, build your gold fortress. A defensive portfolio in 2026 should have 15 to 25% exposure to gold. Split this between physical bars, your insurance against asset seizure and bank failure, and high-quality mining stocks, your growth engine for when the price creates a mania. Third, cash is king. Increase your cash position to 20 to 30%. Why? Because when the crash hits in Wave 2, likely mid-2026, you don't want to be forced to sell. You want to have dry powder, ready to buy high-quality assets when they go on sale at a 50% discount. The Chinese billionaires were right in 2007. They sold 18 months before the collapse, and they saved their fortunes. They are selling again now. The $47 billion signal has been fired. The clock is ticking. You have a 3 to 6 month window to position yourself in Wave 1. By the time Q2 2026 rolls around, the door will be closed. This brings us back to our mission. We are building a community of insiders who are prepared, not panicked. We are racing to hit 1,000 subscribers by December 31st, 2025. If we hit that number, I will release the killer video, my exclusive, vetted list of the top 5 unhedged primary silver and gold miners that I believe will lead the supercycle. I want to publish it, but I need 1,000 insiders to justify the risk. The smart money has left the building. Don't be the last one holding the bag. Subscribe, turn on notifications, and watch the flows. Class dismissed.